Equities sold off big time very, very early on in August. There was a lot of talk at the same time in reaction to this about how the yield curve has changed, how possibly we're moving away from an inverted curve and towards a steep curve. What does all of this mean? How do you interpret a yield curve? So I'm going to give you a brief history from when the Fed stopped raising rates, summer 2023, to where we are now, and how the curve has shifted and what parts of the curve moving tell you different things. So let's start with the move from July 23 to September 23. What's going on here then is a shift on the longer end of the curve. If you look at the image, the right hand side of the image on the green line is much higher than the purple. Whereas on the left hand side, that gives you the market's perspective or perception of where rates are going. What this clearly shows is that they don't believe rates are changing anytime soon, but the longer end of the curve starts to shift higher. What this suggests is that people believe that the economy is going to improve. So they get out of longer end bonds and shift that towards equities. If you go and look at an S&P chart though, the S&P doesn't rally. Why? We won't get into that in too much detail. We cover this a lot more in courses that we run. So if you want to know more about that, click the link, check out the website. But what effectively happens is this raises borrowing costs for companies. So we start to see, because of the speed of this change, equities do start to have a drift down. Remember this, Q3 of last year. What we then get from September to January is a slight different movement in the curve. Let's go and have a little look at that. So from September to January, what you're seeing here is the curve from the September curve in green to the January curve in blue. Almost all of the curve has shifted lower. So at every duration along the curve, yields have dropped. This tells us two things. It tells us one thing really, that actually people's perception of rates going higher or even staying where they are has gone. People now expect rates to fall. So this then drags the curve down across the board. But where it really pulls the curve down and shows rates falling is at the front end. So this is actually a situation now where the curve has, to a degree, steepened. Because what's happened is the front end rates have dropped quickly whilst the long end rates have not fallen quite so dramatically. This suggests people believe, or market participants believe, rate cuts are coming, and they're coming, lots of them, quickly. This is why the equities took off from the beginning of 2024. So all is looking good. The economy seems to be all right. Rates are definitely going to be coming down, but things start to change. Let's go and have a look at the next chart. January to May then. Note, the May green line doesn't look wildly dissimilar to the September 23 green line. What this is telling you now though, is that idea of lots and lots of rate cuts seems to have disappeared. So we're now in a situation where equity markets are still rallying, yet the reason for the rally seems to be disappearing very, very quickly. There are less rate cuts coming. So on that basis, we're now rallying in equities on the idea that, well, less rate cuts don't really matter because the economy is doing all right. And remember, throughout this year, steadily inflation has dropped. All is looking good. So what you're seeing is the long end of the curve starts to rise on the basis that all is looking good. So why do you want long end bonds? Sell them, which pushes yields up. All good. The short end rises on the basis that, well, the Fed's not going to cut rates so many times. Not if at all, but we've gone from, in January, an expectation of 5 or 6 rate cuts by the end of the year, to May, the possibility of 1 or maybe 2. So that's a distinct shift, and that's why the short end of the curve has then moved up as well. So it's understanding what the implication of these different moves in the curve are. Let's go and have a look at then what happens from May to August. Remember, everyone thinks things are going well. What happens from May to August then is that the front end of the curve in August drops dramatically. What this tells you, again, a bit like we saw before, the expectation of rate cuts is back. Now, I'm sure you will have looked at all of these and thought, none of them look like they're actually steeper curves, and they're all inverted, i.e. the left-hand side, the short end of the curve, is higher than the right. That is correct. Now, there's 2 ways that a curve can go from that shape back to a more traditional upwards sloping from bottom left to top right curve. The way that happens is either through significant improvement in data, which pulls the long end up, or a significant deterioration in the economy, which forces the Fed to start to cut interest rates. That sudden drop in equity markets coincides with that. Equities drop, perception of rates going up increases. These are two things that you can kind of look at a bit chicken and egg. If equities drop, the idea of rate cuts coming brings the front end of the curve down. Equally though, if the front end of the curve starts to drop quickly, equities perceive this as a risk that they hadn't perhaps factored in, and that the reason the Fed is cutting rates is there is a problem. So either way, we run the risk at the moment now that if the front end of the curve continues to drop rapidly, short end bonds continue to rally, this could well indicate a bit of bad news and possibly call a high in equities. This is not to say that that will be the case, and the development in the curve in the days and weeks that follow that first week of August is what really matters. But understanding the implications for markets of the way the yield curve moves is really important. So get to grips with it, have a think about the implications and what exactly is going on in that yield curve. If you want to learn more about yield curves, click on the link below, go check out our website. I cover this extensively in the 6-week program. I'll leave you there though, guys. Have a wonderful rest of your day. Hopefully you're enlightened on yield curves. Take care.